Okay, let's start recording again. Okay, so part 2 of today's lecture. So we have now looked at the tax treatment for the lessee. What we are going to look at now is the subsequent measurement, some specific issues with regard to the subsequent measurement. Okay, okay, Ms. Swanepoel, I see a question there. With regards to the finance cost of the factory building, do we reverse it by adding it back? Because even though SARS doesn't differentiate between capital and interest portion, we know the rent expense deductible includes both interest and capital. Thus, we cannot keep the interest expense in the profit before taxes. This will result in a double deduction. Yeah, but remember, if we go to our interest current tax calc, where is that current tax calc? Oh my goodness, it's so dear God. Okay, so remember that this the finance costs over here. The finance cost over here will not be, so what you are suggesting, I suppose, is that we just add a difference between these two amounts. Let's go out, discard, and go back in. So are you suggesting that you just, I don't know, between the finance cost and the actual lease payment, just then calculate a net amount and put that in as a deduction? Is that what you're suggesting, Ms. Swanepoel? You can do that. You can do that, just put in the net amount. So otherwise say, okay, so I'm also going to get the capital portion of that lease payment as a deduction. But you're welcome to do that. It's going to get us to the same answer. But like I said, it's just easier to think about reverse accounting, put in the tax. It's like when you have when you get to IAS 8 later, when we have a prior period error. It's always better to first go and say, okay, let's reverse the entire error, and then we put in the correct transactions. Okay, so you don't have to calculate the net amount and just do a journal for the adjustment. If we get to the same answer at the end, then it's fine. Okay, I'm just trying to understand why we are adding back the interest. Okay, because the interest was an expense, part of my accounting profit. So we have, for accounting purposes, remember that we had depreciation on the right of use asset, and we had an interest expense on the lease liability. But now we have to add both of those back because we don't get the depreciation, and the interest is not recognized by SARS. So we have to add it back to reverse the accounting treatment. And then we say, okay, for tax purposes, we get the full deduction of the payment and the deposit and initial direct costs. Good. Okay. Where are we? Okay, so a subsequent measurement. Let me check the times. Okay. Oh, no, we'll have enough time. I'll get to Ms. Perumal's question as well, I hope. Good. So for the lease liability, when we spoke about subsequent measurement, we said that for the lease liability, we start with our carrying amount of that lease liability, then we're going to add the interest and deduct the lease payment to get our carrying amount. And remember, I told you in a journal, you can do this as a net amount. You don't have to do the two separate journals. I don't know what you were taught in 201, but for 300 and 705, you can just do that net normal amortization journal. Okay, but then paragraph 36 also says, 36 also says that we have to also take into account any lease remeasurement. So if there are any remeasurements of the lease liability, we have to take that into account for our lease liability balance as well. Okay, so now back to our standards. So you're doing some technical stuff now. So in paragraph 39 of IFRS 16, it says, after the commencement date, a lessee shall apply paragraphs 40 to 43 so we're going to get to these paragraphs just now, to remeasure the lease liability to reflect changes to the lease payments. A lessee shall recognize the amount of the remeasurement of the lease liability as an adjustment to the right of use asset. So when we do the remeasurement of the lease liability, we're going to change that carrying amount, make it bigger or make it smaller, whatever the case may be. And the other leg of the journal is going to go to my right of use asset. So we are either going to debit the lease liability and credit the right of use asset. Otherwise, we might also have to credit the lease liability and then debit the right of use asset. So the other leg of these remeasurements that we are going to look at now is going to be the remeasurement is going to, the other leg is going to affect the right of use asset. Okay. So Mr. Olson, so can we just do a net journal from balance at year 1 to balance at year 2? Okay, no, I'm not sure if I understand your question there. We'll get to it later. Okay, but then, so we do this, when we do the remeasurement, the other leg goes to the right of use asset. But then the standard says, if our right of use asset has already been reduced to 0, so the right of use asset has already been written down, then we will fix the lease liability amount, and then the other leg will go to profit or loss, something like a remeasurement loss or remeasurement gain, or whatever the adjustment is. Okay, so that's what paragraph 39 says. Now let's look at what these remeasurements are. Okay, so first of all, in paragraph 40, we find the first 2 remeasurements. And I like to refer to these first 2 as the female remeasurements. Okay, because these remeasurements all have to do with the lessee changing her mind. And we know, as women, we like to change our minds. So so what these remeasurements are is, first of all, with regard to the lease term, and as well as the option to purchase. So that's our female remeasurements, because at the beginning of the lease, we said they were, we said, okay, say for example, there was an option to extend the lease term. At the beginning of the lease, we said, no, I'm not going to use that option. I'm going to just have the shorter lease term. I'm not going to make use of the option to extend. Then at the end of the lease term, you go, an option to extend the lease term. I like that. I think I'm going to use that. Or not at the end, somewhere during the lease term, you decide to actually use that option. So we are changing our minds. Okay. And same with the option to purchase. At the beginning, the lessee might say, oh yes, I want to purchase this asset. It's so cool. I'm definitely going to purchase at the end of the lease term. And then like a year or 2 in, you say, I don't think I'm going to purchase this this asset at the end of the lease term. So there we are. So the lessee is changing her mind. That's what's called the female remeasurements. Okay, so when we have these remeasurements, the first one is then that option to extend, or maybe an option to terminate the lease earlier. So that has to do with a change in the lease term. And the second one has to do with a purchase option. Okay, if we change our minds there. Now, when this happens, then paragraph 40 tells us that we have 40 and 41. There's 40 says that we have to use a revised discount rate. So we have to use a new interest rate. And then we have to also calculate it over the remainder of the lease term. Okay, so when we have female remeasurements, we use a new interest rate. Okay, on the date that we change our minds. Why do we use a new interest rate? Okay, remember that these types of remeasurements, when we're changing the lease term or we're changing our minds with regard to the purchase of the asset, the right of use asset, that significantly changes the nature of the lease agreement. Okay. So that's why we will have to go say, oh, actually, this is now a completely new agreement. It was not. The purchase option was not taken. We didn't think we were going to use it. Now we are going to use it. So therefore, the whole nature of the lease payment changes, or the whole nature of the lease agreement changes. Sorry. Okay, so that's why we use a revised discount rate, and we do it only for over the remainder of the lease term. So on that date when we change our minds, we say, okay, how much time is left in this lease? And then we use the new rate over that remainder period of the lease term and calculate what the lease liability should be. Okay. So that's our female readjustment, where we use the new rate. Let's quickly check the questions. I meant when we subsequently measure the lease liability, the standard says it will reflect lease payments and interest. But I wanted to confirm that you said we could just use the amort function to calculate the balances at each year end, and then do a single journal from balance to balance. That's not, yeah, well, you can use that. I mean, you're going to use the amort function in any way to calculate your interest. So what I meant with that, when I say you can use a net journal, is you are actually going to say, when you do your payment, you're going to say credit bank with a full payment. Let's say that was 150. Then you're going to go and say debit interest. Let's say that was 50, and the other leg debit goes to the lease liability, the 100. Okay, so you would have used your amort function. You would have used your amort function to calculate your interest, or otherwise you could have used your amort function to calculate your balance at the end and your balance at the beginning, which you in any way would have had in your trial balance. And then the difference between these two will be this amount, and you can use this one as the balancing amount in your journal. Otherwise, this one is the balancing. It doesn't matter. Fact of the matter is, you're still going to use your amort function. But that's what I meant with the with a net journal. The fact that, because I think you might have been taught that where you have to say, first of all, debit interest expense, credit lease liability for the first one, and then again say debit lease liability, credit bank with a payment for the second one. Okay, so what I'm saying is you can just do a net amount, do it one journal with 3 legs. Okay, if a lessor charges you a penalty for rescinding your option to purchase, would the penalty be deductible for tax purposes, i.e. the penalty? Okay, but in this case, that option to purchase, there won't be a penalty if you don't exercise that option, because option to purchase just says that at the end of the lease term, you will be the first one to be given the option to purchase that asset or not. So that decision is only made, or the lessor is only informed of that decision at the end of the lease term. So the lessor will take into account, say, yes, definitely, I think the lessee is going to exercise that option or not for the lessor's calculations, but there won't be a penalty for doing that. Okay, that's why it's called an option. You have the option at the end. Yeah. Good. Would the penalty be deductible for tax purposes? I don't know. Go ask your BEL 300 lectures. I'm not a tax lecturer. So remember, if I get 300, we make up our own tax legislation. We'll say, yes, it is, or no, it isn't. But I'm sure it would be deductible if there is a penalty for anything else. Okay, good. Where are we now? So now we looked at our female reassessments, and we saw that we have to use a revised discount rate. Good. Now in paragraph 42, we get to our male remeasurements. Okay. So why do I call these the male remeasurements or reassessments of the lease liability? Because these two remeasurements or reassessments has to do with when we now look at, we're a few years into the lease, and we look at what the amount is going to be that we have to pay in terms of the residual value guarantee. And we see now, oh, that amount has changed. Initially we thought we are going to have to pay this much. Now that amount has changed. And the second one has to do from when we have variable payments that are linked to an index or a rate. And now that index or rate changes, therefore now our lease payments are going to change, and that's going to affect our lease liability. So, so the reason why I call them the male reassessments is because you know how males are. So a man will say, "Ah, but I expected that this is probably going to change the amount that we're going to pay, have to pay under the residual value guarantee. expected it. I knew that this was going to change. Okay, as well as when we have a change in that index order rate that our lease payment is linked to, males are going to say, oh, no, I expected it. I knew it was going to change all along from the beginning. I knew this was going to change. Okay, so that's why I call them the male remeasurements. Okay, so what do we do? How do we treat that? Spot on. Yes, Mr. Groenewald, spot on. Okay, you always think you know everything, and you don't. But never mind. Okay. So what happens if we have one of these two? Oh, Mr. Du Plessis, I'm going to kick you out of this session for using bad language. Okay, I'm the only one who's allowed to swear in this session. Sorry. Okay, so apologize to your fellow students for that bad word. Not to me. I'm waiting for you, Mr. Du Plessis. Okay. Good. Okay. Okay, so if we have a male remeasurement, what do we do with that? So paragraph 43 tells us, that if this is the case, if we have one of these situations, we use an unchanged discount rate. So we continue using the rate that we used for our initial measurement. Because remember, from the beginning we knew it was going to change. So therefore we continue using that old rate. We don't use a new rate. Okay. And then there's an unless hidden under this picture over there. There's an unless there. We'll get to this unless later. So for now, we just know that we use an unchanged discount rate. Good. Okay, so there are our reassessments of the lease liability, our remeasurements that we have to do. So the first two are our female remeasurements, and the number 3 and 4 are our male remeasurements. So for the first two, we use a new interest rate, where for the next, last two, we still continue using the old interest rate. Okay, now we're going to do some class examples. Yay, lots of fun. Okay. So the first class example we're going to look at is example 2. So in your notes and class examples, example 2, where we have a change in the lease term. So I am not going to do the example in detail. You'll see that they usually ask for 2 or 3 or 4 years worth of journals. We're not going to do all of that. I just want to show you specifically the remeasurement. So part of your homework is to go and look at these class examples again. Okay, so example 2 has to do with a change in the lease term. And what makes this example a little bit tricky is the fact that our lease payments are payable in advance, first of all. And also that the lease payments for the first 10 years, that's my initial lease term, is not the same as for my extended lease term. Okay, so there's a little bit of a trick. Good. So this one complicates this example unnecessarily, the fact that it's payable in advance. So don't get too confused by this. Make sure that you understand the principle. Okay, let's go into example 2. Oh, why does my slide not update? There we go. Okay, so in example 2, we have a lease agreement entered into on the 1st of January 2016. It's for 10 years with an option to extend the lease term for another 5 years. Okay, so now at this stage we don't know yet whether our N is going to be 15 or 10, with the option to extend or without the option to extend. So we don't know that yet. The lease payments are 50,000 per year during the initial 10-year term, and then if we do extend it, the lease payments are going to go up to 55,000. The lease payments are payable in advance, with the first such payment payable on the 1st of January X16, which is the commencement date of the lease. Carbonier Limited incurred initial direct costs, which comprises 15,000 paid to a former tenant occupying the floor of the building, and 5,000 relates to a commission paid to an estate agent. These amounts were paid on the 1st of January, and as an incentive to Carbonier Limited for entering into the lease, the lessor agreed to reimburse the estate agent's commission, which was the 5,000. It was received also on the 1st of January 2016. The interest rate implicit in the lease is not readily determinable, Therefore, we're using the incremental borrowing rate of 5%. And again, this will be the before tax interest rate. Good. On the 1st of January X16, there was no reasonable certainty that Commoneer Limited would exercise the option to extend the lease for the additional term of 5 years. So this information here tells us that my N is going to be, initial recognition is only going to be the 10 years the initial period. On 31 December X21, the end of the 6th year of the initial term of the lease, Commoneer Limited decided that it would exercise the option to extend. So now Commoneer is changing her mind. Sorry, I'm changing my mind. And we are going to use it for the additional 5 years. And on this date, our incremental borrowing rate will be 6%. Good. So we know now that this is changing my mind, so I'm going to have to use the new interest rate. We're going to have to use the new interest rate. But know that in a question, I'm always going to give you the old rate and the new rate, because I want to see whether you know if you should use the old or the new rate. Okay, but in this case, we are using the new rate. Good. So initial measurement of the lease liability. Oh, come on. Let me just clear out my workings. Good. So initial measurement of the lease liability. We set our calculator to begin. Remember that, because it's payable in advance. Then our payments 50,000. Future value will be 0 because we're not going to exercise the option to purchase. The period will be 10. The interest per year will be 5%. That's the initial interest rate, giving us a present value of 405,391. Okay, Mr. Duplessis, you are forgiven. Don't worry about it. Cock isn't such a bad word. So there are worse words. Okay. However, we calculated what the present value was, but now we have to remember that the first lease payment was actually paid on the 1st of January, which is the date of the lease, the commencement date of the lease. So therefore, my initial measurement of the lease liability is actually going to be the 405 less that first payment. Okay, remember, because that first payment is almost like a deposit that we had in example 1 and example 7. So we are going to say a credit bank, and then it's actually going to be a debit to the right of use asset. Okay, so otherwise you can just take it off from the lease liability, and yeah. Anyway, you know what I'm saying. So we can either say, we could have said here, debit the right of use asset with 405,391, credit the lease liability 405,391, and then when we make that payment of the first payment, credit bank with 50,000, we'll say debit lease liability with 50,000. Okay, we could do that. Otherwise, we can also just clean my screen again. Otherwise, we can also say debit the right of use asset with 355,391, which is the net amount, and credit the lease liability. So this is the right of use asset, lease liability 355,391, lease liability. And then when we make the payment, we'll say debit right of use asset with a 50,000 and credit bank with a 50,000. Okay. So whatever we do, we are still going to sit with our right of use asset at the 405,391. Okay. So now at the 31st of December 2021, we change our mind. So it's the end of the 6th year. Now we have to do that remeasurement of the lease liability. So you have the solution in front of you, I know, But try and not look at the solution, just try and look at the information and see if you can calculate the balance of the lease liability on this date before I make the change, before I remeasure the lease liability. So just using the information now, see if you can calculate what the lease liability balance is on 31 December 20X21. Yes, Mr. Duplessis, it can be seen as a deposit paid. So that's basically the same thing. But now remember the fact that these payments are payable in advance. If you see it as a deposit paid on day one, yeah, the entry is the same. But yeah, Mr. Armstrong, you can do it that way as well. Thank you. Your typing is much neater than my writing. Okay, so if you see it as a deposit paid, we treat it as a deposit paid, but remember, by including the N10 over here and the beginning, we actually we are still treating it as a lease payment payable on day one. Good. Okay, so we are able to get to that lease liability balance on 31 December 20X21. Okay. So we have got we know that our N is going to be 10, because we initially thought we're not going to extend. The 50,000 is going to be my payment. Oh, we've got everything here, sorry, academic card. And we've got our interest rate. So can you, by using this and using your amort function, can you calculate that balance? Yes, you depreciate on full, because that's what the asset cost you. The asset cost you a lease liability. You still owe 355,391, and you've paid an additional 50,000. So that's what that asset actually cost you. 177,298. I don't know. I can't remember. It's on the next slide. We'll see if you're right. Okay. But why I'm asking you to calculate this is because of the fact that it's so tricky, because it's payable in advance. Okay, so let's look at that calculation of the balance of the lease liability before the remeasurement. Okay, so the trick here is to remember, so the balance is 186,163. Ah, Ms. Willemse, so I caught you out. Okay. Don't we also add the initial direct cost, the less incurred to the cost of the right of use asset? Yes, we will. But you're right, but that has nothing to do with the lease liability. But same. Okay, I got the same as Mr. Schrempel. Where did Mr. Schrempel say how much he got? Anyway, I don't see it. Okay, so the reason why this is a tricky calculation to calculate the balance is because of the fact that these payments are payable in advance. So what happens here? Here we have here's our lease term from year 1 to year 10. 10 couldn't fit in the circle. That's why I'm using an X. Anyway, so what happens when you ask your calculator to give you the balance? So now we want the balance at the end of the 6th year. So we want the balance over here. Okay, that's the balance that we want. But if we ask our calculator to give us the balance after period 6, it's going to give us the balance after the 6th payment has been paid. So that's what the calculator does. When it talks about a balance, it talks about the balance after the 6th payment. So if you ask the calculator amort 1 balance, then you're going to get the balance after the 1st payment has been made. Okay, and the same with if you ask it to calculate the amort or the balance for amort 6, it's giving you the balance after this payment has been made, the 6th payment. But our financial year only ends over here. So what that means is we still have to add the interest for this period. And that interest will be included in payment 7. So for my payment, my 7th payment over here, the interest portion is going to be so this is the interest for year 6. Okay. And that's why we have to add that. Okay, so that's just a little bit the tricky thing about this this question. The fact that you have to know what your calculator does. When you set your calculator to beginning and you ask it for amort function balance, it's going to give you the balance after the payment, which is going to be at the beginning of the year. Good. So that's the tricky bit about this. So if it was not payable in advance, the balance would just be the amount from our calculator. Yes, yes, exactly. Okay, good. Everyone happy with that? So now we have our balance of our lease liability on 31 December 2021. Now we decide to exercise our option to extend the lease term. So now we change our mind, and we exercise that option to extend. And remember what we said is the moment we do that, then we are going to have to use the new interest rate over the remainder of the lease term. Good. Okay. So now we have to remeasure that lease liability over the remainder of the lease term. So what we have over here is then now we can't use our payment functions on our calculator because of the fact that these lease payments differ. We're going to pay, we have 1, 2, 3, 4 remaining payments of 50,000, and then we have 1, 2, 3, 4, 5 payments of 55,000. So we have to use our cash flow function. Now again, remember, because it's payable in advance, your first 50,000 should be cash flow 0 because it's going to be paid on the next day. So on the first day of year 7, we are going to make that payment. And then these payments are going to be the 50,000 payments. And then for the extended period, we are going to pay 5 payments of 55,000. Okay, and we use a new interest rate, and that gives us then our new net present value. Okay. There's a question here. Interest for the 7. So if it was not payable, yeah, okay, ma'am, can you please repeat the interest portion? Okay, cool, I'll do that. So we get the balance amort 6, input 6, and then add interest of amort 7. Yes, yes. Good. So repeat the interest portion. Let's quickly do that to make sure you've got that. Because it is a bit tricky, but it's not if okay, 300 tricky, it's just calculator tricky. So the fact that when you ask your calculator for a balance, if you use your calculator and you say amort 6 balance, it's going to give you the balance after the payment, the 6th payment has been paid. So it gives us the balance at this point. However, we do our SFP for the end of the year. So during this year, during this period, the liability would have increased with the interest for that year. And that interest, when we pay our 7th payment, here you'll see the 7th payment, so it's 1, 2, 3, 4, 5, 6, 7. The 7th payment, if we do that split, the amort split, we see how much interest is included in that payment, what's the capital portion, then what they're giving us with our payment, the 50,000 payment for payment 7, so this payment over here, we are actually paying the interest for year 6. It's getting them a card again. Let's discard and do it again. So this payment over here has an interest portion and it has a capital portion. But that interest portion is the interest for this period. So that's why we have to add payment 7. Payment 7's, oh gosh, interest to our lease liability. Okay. Hopelang, did I answer your question? I hope so. Could we also do the amort 7 balance and add back the 50,000 payment? So if you do the amort 7 balance, it's going to give us our balance after the payment has been made. So you cannot add back the 50,000. You are going to then have to, because then you are then getting this balance, 136,163. Let me just get my calculator out to audit myself. 136,163. So you will have to add back the capital amount of the payment, 41135. No, wait. It is the 50,000. Capital outstanding. Well, yeah, it does give us the same amount. If you add the 50,000. Yeah, you're right. After the payment. Okay, yes, you can do that as well. 186163. Yeah. Okay. Good. I like it when my students are smarter than I am. Okay, that's the plan. That's the plan, that you should go, you should stand on my shoulders and actually be able to reach further. It's the point of teaching. Okay. Okay, so now we've exercised that option. We not exercised it yet. We just changed our minds that we are going to say that now, but just wait for the CV. Yes, that is a that is an interesting experience. Marking tests. When we're marking, we take screenshots of the funny things that we see, and then we arrange for a tea break somewhere where all the lecturers get together and we sit and we laugh over all the silly things that the students tell us. But we do that with respect. We don't laugh at you, we laugh with you. Don't worry, Mr. Tsetse. There's nothing that new that you can do. After 12 years in academia, I can tell you that I've seen quite a lot. So it won't be that new, the funny things that we see. Okay. Yes, you provide us with some laugh. Okay, good. So now we have, at the moment, our balance is 186,163, but we've calculated that the balance should actually be 378,174. So we are going to have to increase the liability from 186,163 to 378,174. So we'll need a journal for 192,011 where we increase our liability, our lease liability. Okay, and the other leg goes to my right of use asset. Good. So that's then the reassessment of the extension option to extend the lease. Obviously now when you calculate your depreciation for year 7 on that asset, you are going to now take that take this additional amount into account, and you are going to divide it over the remaining period then of the lease, which is going to be the 4 years remaining of the initial lease term plus the 5 years of the extension period. Good. You also measured using the cash flows discount at the new rate. Now, remember, if these payments were the same, then we would not need to do the cash flow function. Then we could actually do the we could actually use our present value payment future value function on our calculator, that like we did over here. The problem just that we have is because of the fact that the payments change, we have to use our cash flow function. So that's why we do that. But yes, we will always use the new interest rate, because remember, we are changing our minds and changing the nature of the lease agreement. Therefore, we use the new interest rate. Okay. Okay, now we've done that. Let's look at the second one when we change our minds with regard to the purchase option. So again, we still have to use the new rate over the remainder of the lease term. So they give us an example. We are leasing, so this is example 3. We are leasing a printing machine. Leases for 4 years, so N is 4. In terms of lease agreement, lease payments are payable annually in arrears. Dankie tog, they're payable in arrears. So that's my payment amount. The lease contains a purchase option that will enable the lessee to purchase the printing machine at the end of the lease term of 4 years for 45,000. So that's going to be my future value, but I don't yet know whether I am going to use that option or not. There was no reasonable certainty that Carmania Limited would exercise that option. Therefore, we now know that the future value at initial recognition will be 0. No initial direct cost, interest rate cannot be determined. Therefore, we use the incremental borrowing rate of 8.5%. So that's my old rate. Now, a few years later, at the end of the current year, what happened was the prices of new machines went up. So we decided that we are going to exercise the option. And at this date, the incremental borrowing rate was 9.5% per annum. So that's my new rate. Okay, 31 December reporting date. Estimated useful life on the printing machine was 8 years. Estimate has remained unchanged. Okay, so the fact that my estimated useful life was 8 years, but initially my lease term is only 4 years, means that initially I would have had depreciation just over the 4 years. However, later when we now decide say we are going to exercise the option to purchase, then we are going to use actually the full useful life. Okay. Can I use the amort function when using the cash flow method? I can't seem to get the right answer when trying it on my own. I think you should be able to use the amort function. I think so. Yeah, maybe we can test it later, but I think that amort function works with the cash flows, but I'm not 100% sure. Okay. So initially, my initial measurement of the lease liability, we have our payment of 350, future value was 0 because we initially thought we're not going to exercise the option to purchase 4 years, interest rate 8.5%, and that gives us a present value of the lease liability of 1.1 million. Okay, so if I now ask my calculator what the balance will be at the end of the year when we change our mind using the initial estimate that we made about the purchase option, then that gives us a balance of 893,908 at the end of the year. Okay, but on this date, we decided that we are going to probably use the option to purchase at the end. So therefore, we have to remeasure our lease liability. Okay, so now we don't go, we've actually, during our current year, we've accounted for the lease using this information. Now, at the end of the year, in our GL account, we have this amount sitting there, and now we have to remeasure that. And we have to actually do it, even though the lease happened in that year and the reassessment happened that year, we don't go back to the beginning of the year and say, as if we have initially, we knew from the start that we are going to change our mind, or that we are going to purchase this machine. We don't do that. We have to recognize this remeasurement on the date that we actually change our minds. Okay, so therefore, because we will have to show the users of the financial statements, this is the amount of the remeasurement of that lease liability, and we actually changed our minds about the purchase option. Okay, so we now know for option to purchase that we have to use the new interest rate, and yeah, we have to use over the remainder of the lease term. Good. So if we do that, then we see, what did I do now? No? Yes. Okay. So if we do that, then we see that our present value of the lease on 31 December X16 will be 912,392. If we now include that purchase option into our calculations. So we have to now remeasure our lease liability from the 893,908 to the 912,392. Okay. So how would we do that? There we see our journals. So there we see our journals, and we see that here's our remeasurement. So the difference between the 912,392 and the 893,908 is 18,484, which is the amount that we are remeasuring our lease liability with. Why is this not considered a change in estimate? If not, why? It is going to be considered a change in estimate. And it will be accounted for in terms of IS 8, but we will not, you'll only do that in IFRS 705 next year. Why not use the remaining useful life, the asset of 8 years? But remember, the 8 years, wasn't the 8 years? Yes, so the total estimated useful life was 8 years. So therefore, when we now do our, okay, so remember now, this is during our 2016 financial year. Okay, so 2016 here. We only remeasured at the end of the year. So my depreciation for this period will still be based on my initial measurement, my initial estimates. So that's why our depreciation is still going to be over 4 years. But you will see when you look at the journals for 2017, there we use the remaining lease term. Oh no, not remaining lease term, remaining useful life. Which is then going to be 7 years. Okay, ma'am, I just did the calcs and you can use it as if from start. I also got 912392. Or is it wrong to do that? Can you give me a reason why it's wrong? I'm not sure. I just did the calcs and you can use it as if from start. And I also got to the 912391. Okay, so what you did is you entered a N of 4, calculated the present value, and then you said amort 1 balance. Am I right? Yes. Okay, that will obviously be the case that you get that that answer. If you change your N, if you go and change your N to 10, and you say amort, so then it's going to be what? Amort, amort, but you still get, you will get to that same answer. Because we are looking at the remaining payments work back to a present value at a certain date. So okay, let's make it easier. If you change this this N to 5 and you say amort 2 balance, you are also going to get 912392. Wouldn't the payment need to be negative? Yes. Although, no, what's going to happen here is that your payment and your future value has to be the same sign. And then when you calculate your present value, you'll see that this is actually calculated as a negative amount. Otherwise, you could do your payments as negative, your payment negative, future value is negative, giving you a present value of positive. So it doesn't matter, just as long as these two signs are the same, and you know what you're calculating. But I just did not type. Okay, so Mr. Du Plessis, are you happy with what I'm saying? Okay, so are you happy with what I said about the fact that if you do the lease payment from the start, if you say 4, you're going to get an amount, but then you have to say amort 1 balance. But it's the same principle as if you said 5 over here, then you have to say amort 2 balance. You're going to get the same answer. Okay, but the fact is we are still, even if you're doing this and you use amort 1, you are still measuring that liability just for the remaining period. Good, cool. If we're supposed to calculate interest rate implicit and there is a change in lease term, would we have to calculate the new interest rate implicit? Yes, you'll have to calculate the new interest rate. Yeah, so we will have to do that. Good. There's our, oh yes, this is what I wanted to show you. So this is the depreciation expense. Someone asked about the depreciation. So this is now the next year's depreciation journal, and there we're taking the initial measurement of the lease liability and the right of use asset, and this is the depreciation for 2016 depreciation, and we're adding the 18484, and then we are calculating depreciation over the 7 years remaining. Okay. Cool. Now, the next one is you find an example 4. That's the change when of the amount payable under residual value guarantee. Now, this one you did in FRK 201, so I'm not going to spend time on that remeasurement. And I see that our time is almost finished. Okay, so therefore this one, go and look at example 4 on your own, and then we will, yeah, I'm not going to have time to look at example 5 and 6 in today's lecture, so therefore we will only look at it on Tuesday, and obviously then it cannot be in the scope for Monday CEV. Okay, so up until here you have to study for the CEV, up until what we, well actually this one. Okay, up until here. That's what you have to study for the CEV. We will look at the reassessments due to change in index or rate, example 5 and example 6 in Tuesday. No, Wednesday's lecture. Remember Wednesday. Less studying to do. Woohoo! It's always a bonus. How would all these adjustments affect the deferred tax and the current tax calcs? Okay, good question. Remember that when we do our remeasurement, here at the end, we are now messing with the carrying amount of the right of use asset and the lease liability. So all that's going to happen in our deferred tax calc, temporary difference deferred tax, is now my right of use asset is just going to be a higher amount, 18,000 more, and my lease liability is going to be 18,000 more as well. So tax base still stays 0, giving us that the temporary difference in the deferred tax. So there's nothing weird that happens because of this reassessment. Okay. Note all these adjustments, the deferred and current tax now. I can't remember that we did a change in the amount payable under the residual value guarantee in FRK 201 or 2, yeah. Ooh, okay. Well, then even less studying to do. Then you only have to study up until here. Then we'll do this in Wednesday's lecture. Okay, I remember now that you mentioned that, I actually remember that that we changed that for you guys last year. Okay, so that's all from me then for today's lecture. Let's just see, example, I want to just quickly check your homework, because there will be some of the questions now that you won't be able to do. See, there's still a lot of, where am I now? Yeah, okay. I think, I can't remember which of these. Yeah, so question 14 has the reassessments of the lease liability. Yeah, so I think you can leave that one out. And question 10, variable interest rate, so don't do that one yet. Otherwise, you should be fine with your homework. Great lesson. Woo, I'm so glad to hear that. Okay. I'm glad you are having fun, because I'm having a lot of fun as well. Okay, so I'm going to stop the recording. Good luck with your CVs.